I want to go over a proven plan in this video to talk about how you can build income for your retirement. And it is a boring plan, but it's consistent and it will help you retire in confidence and you'll be ready to retire. Hi, my name is Jeff Wright. I'm with Creek Capital. We focus on helping blue collar business owners, pre-retirees build an income stream for retirement that they can count on so that they can enjoy their retirement and live their life by design. So I'm going to share my screen and I want to go over how you can build this income and have confidence in your retirement. Okay, that took a second there. All right, you'll see these projections behind me. I just met with a new client and we went over these exact scenarios, and you should have seen their eyes light up when they see the power of compounding dividends. Yes, we focus on dividend growth portfolios for income, but the key is not just the dividend, it's the growth of the dividend. So let's take a 20-year projection, $100,000. We're not going to add any money to the account. We're just going to say $100,000. Again, let me say this is for informational purposes only. This is not investment advice, and past performance does not predict future performance or guarantee future performance. But see if you can't get the vision that this person saw today in the meeting. So $100,000, you're not adding any money to it. You take a 4% yield, a 6% dividend growth. And what that means is the dividend yield is growing by 6% every year. You can use data to get these numbers. This is not something that you're guessing on or hoping for. You can actually pull data from companies that give you their dividend growth rates and their yields also, for that matter. Let's assume a 5% price appreciation. And we're going to have that assumption because, one, that's about half of the appreciation that the stock market is seeing each year. So we're super conservative on that. I feel like that's probably pretty low. And again, the whole purpose of dividend growth is that if a company is able to grow their dividend, in this case, in this example, 6%, most of the time, that means that the earnings of that company are growing. And if the earnings of that company are growing, then the share price of that company is typically going to grow. Again, this is not guaranteed. I'm not promising anything, but this is just how the stock market works. The stock market is driven by corporate profits. It's not driven by news headlines or short-term news events. At the end of the day, it's going to be driven by corporate profits from the companies that make up the market. And, like in the S&P 500, those 500 companies, if they grow their profits, the S&P 500 is going to increase over time. So that's the 5% appreciation. Let's look at these numbers. The first year, you have a yield of 4.37%. Just, $4,000 of annual dividend income. Let's jump down to year 15. You can see that dividend income increases to $43,000 a year, and your yield on your initial investment is 47%. That means that by year 15, you are averaging a 47% return just on dividend income alone. This is how you beat the stock market. You don't guess, you don't gamble, you invest in solid companies that you understand that, again, are growing their earnings, growing their cash flow, and paying that profit back to shareholders like you and me in the form of a dividend. By year 20, look at the power of that compounding. From year 15 to year 20, you're actually going from $100,000 in annual dividends to $125,000. It jumps that much just in year 19 to 20. So year 15 is 43,000. So I'm sorry, let me say that again. You're really jumping from 43,000 to 125,000 in the last 5 years of that 20 years. So the compounding is enormous once you get into this. And the point of this is it's not complicated. It's actually very simple, but most people don't do it because they can't have the discipline to stick with honestly such a simple plan. And so I want to help you be able to follow this plan. So let's keep going here. There's some key takeaways that let's point out. Uh, Again, $100,000. You're not adding another dollar to it. Your portfolio over the 20-year time frame grows 11.4 times. Your annual dividend income hits $125,000 a year. That is just in dividend income alone. You're not spending your principal. That's another key advantage to this type of investing. When you get to retirement, you don't want to erode your principal by pulling from it every year. You want to be able to have your portfolio produce income that keeps you from taking away from that principal amount that grows. And with dividends, and in this case, you're able to take out over $10,000 a month just in dividend income alone. You're not touching the principal. Your yield on this $100,000 reaches 137%. That means you're getting your annual initial investment of that $100,000 every year just in dividend income alone at this point. $676,000 in total dividends collected. I've already said this, but let me say it again. The hockey stick is real. When you go from year 15 to year 20, the last 5 years produce more than the first 15 years combined. Okay, let's look at another real life example. So Schwab has a dividend ETF that's super popular. SCHD is the ticker. You'll see it here. And we're pulling in, I use Claude to be able to do this, to pull this data. The current dividend yield on SCHD is 3.45%. This is the last 4 quarters. So the last year, basically, the dividend growth rate is 10%. That's a historical growth rate. Again, those are real numbers. I'm not making that up. You can go get these numbers. Again, you're not guessing. You're not hoping. That price appreciation is historically been around 8% a year. So that's higher than the 5% that I put in the example above. You've got an extremely low expense ratio because it's Charles Schwab, and it pays dividends quarterly. All right, let's take that $100,000 again. You're reinvesting the dividends, and let's say it's in a tax-advantaged IRA. By year 1, you're $3,600 in annual dividends. Look how this grows. By year 15, you're at annual dividends of $109,000 a year, 121% yield on that return. And by year 20, you're at $583,000 in annual dividends, a 680% yield on that initial $100,000. Again, this is a $100,000 lump sum in a tax advantaged account that creates incredible results over the long term just by sticking to a disciplined plan with dividend growth. $583,000 in annual dividend income. Again, that's not touching the principal. That's pretty incredible. And again, just catch the vision of this. I can help you look at your current situation, and we can go through what your scenario might look like. It doesn't really matter if you don't have 20 years to put into this. Let's say you might say, hey, I only have 5 years, or I only have 10 years. Let's talk and come look at your specific situation, and we can see where you can be with your retirement and your income using a strategy like this. There's a few important things to remember just for context as I finish. These numbers, well, the first numbers that I showed you assumed no taxes, a consistent 6% dividend growth rate. Again, we can look at data for that, and a steady 5% price appreciation. So that was the first example. On the Schwab example, those were real numbers from historical performance of SCHD, the dividend ETF. And again, that was a tax advantaged IRA. So again, this is for informational purposes only. Future performance is not predicted by past performance. I can't tell you what's going to happen, right? But this is the one of the best ways to be assured of income for your retirement in a way that is predictable and steady and proven through dividend growth. Please like and follow. Please reach out, schedule an appointment with the link in the description below. Again, my name is Jeff Wright. I would love to help you be ready to retire.